Well, we had a rally for 8 straight days, and today the market ended a little negative. Not the worst thing in the world. We've had a very nice run lately. We had a correction start about a month ago, and the NASDAQ in particular went into correction territory. But ever since we got to that correction point, the market's up almost 10%. So I'm not going to complain. I think it's been a pretty nice rise to especially technology stocks rebounding as well as other stocks out there. So overall, the market is on a very nice trajectory going up. The NASDAQ's up 32%, bringing in the S&P to this comparison, as well as the Dow, and then adding the Russell, which is small companies, to the comparison. You can see that all the indexes are doing quite well. The NASDAQ's doing the best, up 32% in 1 year. The S&P is up 27%. The Dow's up 18.5%, and then the Russell's up 15%. Just very good returns across the board. Small stocks, tech stocks, and so forth. We look at the last month, it was, a down month overall, but you can see that Dow held up the best. The S&P held up fairly well, close to flat, and the NASDAQ's only down 1% over the last month. The Russell, small stocks are just not really rallying, which is interesting. So that's what's going on with the markets. Where it goes from here, I have no idea, but I'm willing to, expect that we might be up a couple percentage points from here. You think about the momentum is going to the positive. I don't see a lot of negative stories out there that can really torpedo a good stock market. We've had a nice correction about a month ago. So I could see us going up a couple more percentage points from here. We'll see what happens. Overall, I'm going to stay invested in the stock market. I do have cash and can buy stocks. I'm trying to find a couple good stocks to put that capital to good use. But, cash is paying a fair amount. I'm beginning to sell some put options as well on stocks that I think that's a good idea with. That generates some income overall. A couple of stocks, or before I go to stocks, let's take a look at sectors. The sector that performed the best today was healthcare, which is a very good signal. Healthcare tends to be good in any economy. It's good in a growing economy. It's good in a recessionary economy. And it showed up today as an example. It's also been doing well year to date. And over a long period of time, it does have a high rate of performance, which is very good. Not as good as technology, but it's, I think, the third best sector behind technology and consumer discretionary, which is where Alphabet, Google is, as well as Meta, Netflix. And Netflix had a good day today. So I really like that trend because healthcare hasn't been doing all that great over the last 2 years. And I think it has a lot of room to go up to the upside. So good to see that happening. Consumer staples, which is typical when all other stocks are down, consumer staples tend to go up. Now, energy was the worst performer. I think oil prices really crashed a bit. And other sectors out there, materials was down, industrials was down, financials were down, but it's not too bad. I mean, we were down just a little bit, not a whole lot. Year to date, the sector leading the pack year to date is still technology. No big surprise. Consumer services, no big surprise. Healthcare is right there in third place. So things are setting up well. I continue to be very optimistic that healthcare is going to do well. Looks like I've got a comment. So can we check Merck and Valero Energy? Yeah, we can look at Merck. I did do a video on Merck, I think in the last month. And my conclusion was that it may be a little overpriced. I'll take a look at it and see where we're at now. Valero Energy, haven't looked at that one. So let's take a look at Valero in a bit. All right, so that's where we are with sectors. Now, a bit of news before I jump into those two stocks that came up. One of the things that I continue to repeat is that the AI hype is really, to some extent, really out of control. People expect that AI businesses are going to get started and they're going to revolutionize industries and markets. And, I think AI is going to be super interesting, but it's not going to happen as fast as people think. And here's an example. Just today, Anthropic, which is a very big AI company, has a class action lawsuit to deal with now, where they took a lot of textbook and book information into their large language model. And now those publishers say, you took all that intellectual property without our permission and built your business, so we're going to sue you. I expect this type of conflict or tension to happen over and over again, because a lot of these companies that created either a book with intellectual property or new ideas, if AI absorbs those ideas just by getting the text and putting it into their large language models, you have to gain permission to do so. And I mean, there's going to be case after case. Here's one just for today, just happened. I just saw it today. And that's another reason why I think AI is going to be something, but it's going to happen over time. We're going to need to get some of these issues put to rest. Some of these lawsuits are going to have to happen in order for the industries to establish the guardrails. How far can you go? What kind of content can you bring into these large language models? ChatGPT, the biggest one, OpenAI, they were an actor, said, hey, you used my voice to replicate what is in essence an artificial voice of mine. And they denied it first, but then when there was further investigation, it was acknowledged that OpenAI used that actor's voice, and they took that voice off their platform. That's another example. I mean, they're not going to be able to use a lot of the voices and content into the AI models that freely, and they shouldn't, because they're in a way stealing that company or that person's intellectual property. So we'll see how things play out, but I thought it was interesting to see that. All right, so let's jump in. Hey, Quags, very nice to see you, man. Hopefully you're making lots of money in this up market. I would love to hear that that's the case for you, my man. Let's talk about some of these stocks that came up. First one, I'm going to go to Valero first, because I haven't seen Valero in a long time. And let me get reacquainted with this company. So this company manufactures, markets, sells petroleum-based, low-carbon liquid transportation fuels and petrochemical products in the United States. Okay, got it. Oil and gas refining and marketing, got it. So they use petroleum products. They're a downstream company selling to that end consumer, that end person that uses the fuel, uses the lubricants, and so forth. It's a $45 billion company with revenue of $134 million. So you're paying for less than revenue for this company by a substantial amount. The PE is really low, 8.23. Holy smokes. PE, forward PE is a little higher, 12.5. Pretty decent dividend at nearly 3%. Analysts like it, and they're saying it's discounted by 23%. All right. When we look at their financials, and these companies, these energy companies, are really dependent on where oil prices and gasoline prices are. In the case of Valero, since they're downstream, and if gasoline prices are high, their revenues grow. If gasoline prices are low, their revenues drop. In 21, we had a spike in fuel costs and oil prices. So oil companies really saw their revenues grow. And now we're seeing that it's really hard to sustain that when you have lower prices. So that's understandable. It's not that Valero's doing, something bad. If you saw Chevron or Exxon, you'd be seeing the same trend. When we go to free cash flow, it's a nice cash flow generating company, generating about $8 billion of free cash flow if we look at the trailing 12 months. Now, energy, you can really value this company at a discount, because $80 billion, if you just multiply it times 10, you get to 80 billion, right? So they generate $8 billion of free cash. If you divide 8 billion by 45, you're getting to about an 8% yield on your sales. You yield 8% free cash, which is very good. Having said that, this probably is a discounted stock. If an investor was looking for an energy company, this might be a good idea. Now, other things about Valero. When you look at the oil business, there's companies that explore for oil. That's referred to as upstream. They're finding the oil. They're doing it through some sciences, a lot of geology involved. Then they find the oil. They drill holes in the surface of the earth. They extract the oil. They get it out in a raw material, crude oil. And then they put it into a refining process. And then that's kind of like the midstream, transporting it, refining it. And then you have downstream, which is, okay, we turned it into gasoline, diesel, lubricants, butane, propane, all kinds of things that come out of that crude oil. Valero participates on the downstream part of that market. They're dependent on Exxon, Chevron, all the oil explorers. And I think Quag said prospecting. You could use that term. They're prospecting for oil and finding it. And then they're taking that oil price and putting it into their process. So in my opinion, this part of the market isn't as profitable as the upstream, because when oil prices go up, those guys are just printing money. They're sucking raw oil out of the ground and selling it for $100, $200 a barrel, which is very profitable. Valero has to pay for the processing of the crude oil. And by the time they get it, they do make money, but it's kind of a controlled and a limited, profitability. I think Valero looks like a solid company paying a good dividend. If you are looking for an energy company, it's not a bad idea. I'm in Chevron. I like with a fully integrated company that does upstream, midstream, downstream in their production. It's diversified. It's one of the bigs. It's a big market cap, and I'm comfortable with Chevron. So Valero wouldn't be the right investment for me, but it could be a good investment for somebody else. Our friend, or I should say, Warren Buffett, which is pretty much idolized by so many investors like myself. He's into Chevron and Occidental. Occidental is mostly on the upstream, and they're not a fully integrated oil company, but they're on that part of the market. So even Warren Buffett likes the upstream side of the business because that's where the big money could be made. So those are my comments on Valero. Good luck with that stock, and hopefully you can do the analysis and make your decision, based on what you're thinking of the company. Good luck with that. All right, let's go into Merck, and we could also look at some of these comments that are coming through. So Merck is a pharmaceutical company, and I think most people know who Merck is. There's a lot of choices in pharmaceutical. I think when I looked at it, I did not like it. Let's take a look. It's been going up over the last 5 years. Over the last year, it's up only 5%, and it really came down. Interesting. I don't know when I did my video, but I don't know if it was before or after July 29th. My conclusion was I didn't think the price of the stock was appropriate. I thought it was being priced at a premium. You can check my video for further details on Merck. I went through the whole valuation of Merck. In fact, I have their valuation here that should be somewhat time-stamped, because if I kept it, it should still be here. Let's take a look. No, I did not keep it. So if I decide that a stock isn't worth tracking, I don't save it. But the video will show that I thought the stock was being priced too high. Now, I think there's really good choices in pharmaceutical. My favorite, stock that compares to this is probably Pfizer. And the reason Pfizer's there because it's been so discounted that I think it has a lot of upside. Merck, it's had a pretty good correction, so it might be discounted now. I don't know if my video was before or after this big drop. It pays a decent dividend, but I think Pfizer might pay a little bit better dividend. Let's take a look real quick. So Pfizer pays 5.79% dividend. That's really good. Pfizer, was really beaten up. This is why I'm buying into Pfizer's. The market's just completely selling the stock off. And I like this graphing tool more. So let me get to my favorite graphing tool and look at Pfizer. So the market said, okay, COVID's over. We think you're not worth much, so I'm going to discount you by 57%. But if you look at the revenue, the company is much larger than they were before COVID. They have more cash. They acquired a new business that's going to have a run rate of $5 billion of revenue. I mean, a lot of good things happened to Pfizer, which is why I think it has a lot of room to go up. We've seen the stock rally recently. If you look at the last, I guess, couple months, it's up about 14%. I think it has pretty good upside. I'm buying into Pfizer and I like the dividend, but I'm not a strict dividend investor. I don't invest just for dividends. I'd rather see my stock double in value over 5 years than they pay me a nice dividend. But I just wanted to show if dividend is important to somebody, Pfizer pays a pretty decent dividend. Analysts agree that Pfizer is discounted, and I think it has really good upside. I've been tracking Pfizer for years now, and I really like the new business they acquired. It really deals with some cancers. It has a drug that's already been approved by the FDA. It should have a very good run rate of revenue, and it should be a really profitable franchise for them. So that's where I'm going to in the same category as Merck. Those are my comments on Merck. Again, I'm just an investor providing my comments and reviews of stocks. I don't make any recommendations on any stock I ever talk about, and providing no financial advice. Please make your decisions very carefully and independent of anything that I say. All right, so let me catch up on some comments. Quag, how are you, sir? So you like Chevron and ET Energy Transfer. Those are two very good stocks, man. They've been really good for a while. Hi, how you doing? Very nice for you to join. What do you think about PEP, long-term stock, PEP? Pepsi. So this is a beverage company. I think we know it. And they do beverage, and I think they also do some food, right? I think they do snack foods. Now, Pepsi and Coke are easy for investors to put their heads around. And I don't think it takes, a lot of imagination to understand what these guys do. They manufacture beverages and then they sell them to the public. These are not investments that I like, and I'll tell you why. Over the last 5 years, it's done 37%. But principally, what I'm trying to do is I'm trying to find like the next company that is going to be squarely in the most desirable space of the type of company that has a really wide and strong moat, keeping competitors out of their market, being able to grow at a very accelerated rate, make lots of profit, make lots of cash flow, and become potentially the next Microsoft, the next Apple, the next NVDA. And Pepsi doesn't resemble that. Pepsi's a good company, but they are clearly in a very competitive market. Their growth rate, they grow very little. Now, I'm not going to put them in the red, which is companies that have too much competition, are unprofitable. They don't generate any cash. Pepsi does generate cash. They generate a dividend and so forth. So it's a decent stock. Now, I'm not going to put them anywhere close to the green because I consider their Pepsi beverage to be, mind-blowing. If anything, in the beverage market, those energy drinks are all the craze. Monster beverage, Red Bull, Celsius. That's where like a lot of the attention and energy is going to. A lot of the momentum is with those energy stocks. So I would put Pepsi kind of in the gray and, kind of closer to the red. It's not a great industry for me. So on principle, I'm not a buyer of Pepsi or Coke or anything that has this really old business, and nothing against their industries. It's just been around so long. They just have too much competition. A lot of the innovations are done. I mean, what are they going to do to innovate? Make a can that's just a little bit lighter, There's just not a lot of room there. I'd rather spend my time and capital looking for companies here. Having said that, if an investor is looking at Pepsi, I think it's a high quality stock. It's recognized by many, many investors. The idea behind Pepsi is trying to catch it when it's in a low price. For example, if you bought it at $158 a share, you'd be very happy. You'd probably be sitting on a nice gain, but you'd be a swing trader. I'd like to spend my time finding stocks that I can double the value of that stock value over the next 5 years. That's the road that I'm on. I'm not going to nail every single one. I'm probably going to buy a couple stocks that are complete disasters. But if I can find a couple stocks that are just absolute winners like Uber, I'd be very happy. So that's what I'm trying to do. And that's why Pepsi doesn't fit into my investing portfolio. But I've only got quality things to say about Pepsi. All right. So good luck with Pepsi out there. All right. So thank you. Thank you for showing up, asking your questions. I appreciate it. Frito-Lay. That's right. They own Frito-Lay, man. So, Bros. Okay. So I think Bros is Dutch Brothers, right? All right. So Dutch Brothers, just a quick, I guess data point is, I guess about 10 years ago, I love taking my family on trips, and my sons are now adults. And when they were little kids, it was a lot easier to jump on a plane and go visit a place. And we were traveling Oregon, and we went into Dutch Brothers like 10 years ago, and they were really nice. Loved the franchise. Now they compete against the big behemoth, which is Starbucks, and Starbucks is on every corner, it seems. And I'm an investor in Starbucks because I believe that the Starbucks brand, their business, their retail business, as well as their consumer packaged goods business, because they sell their coffee in grocery stores, just has a lot of value. And to this point, it's been a very good investment. I've only started buying into Starbucks, I would say, in the last 2-3 months, and I benefited from the change in the CEO. The stock price jumped up more than 20%. So I'm up on Starbucks like 20% in 2-3 months. So very happy camper with Starbucks. Dutch Brothers, I think, is interesting, but I don't really buy into a lot of restaurants, and this is classified as a restaurant. I think they have room to grow. Most definitely. They're growing nicely, but they're $1 billion run rate company. Starbucks is massive. Okay. These guys are not really on Starbucks's radar. Starbucks has seen 100 mom and pops come and go, and nobody's ever risen to the level of Starbucks. It's not going to be a Coke and Pepsi kind of situation. It could be if these guys continue to execute really effectively. Now, recently, these guys, I think they had a little bit of bad news, and it really drove their stock price down. I think part of it is their cost structure. When you operate a restaurant, you got to hire people, you got to rent real estate. I mean, it's expensive and it's not very profitable. Remember this little graph here, right? Now, I want businesses that make lots of money, like Meta, right, on Facebook. They don't have to pay for really expensive leases. They don't have to pay a bunch of employees. The actual users of the platform are creating all the content and so forth. It's extremely profitable. So Meta is clearly in the green. Restaurants tend to be in the red. Now, Dutch Brothers, I wouldn't put in the red because I think they're growing. They'd be solidly in the gray. But again, if I'm looking for a $1 billion revenue company, I'd probably go to a technology company. I'd probably go to a company where I could see them at some point being a $10 billion company. I could see them being worth, 5 times their current value. And it's hard for me to imagine Dutch Brothers really growing to that size and really doubling in value. So this principle here of I want companies with strong moats, very few competitors. I want them to have high margins, very high cash flow. That's where Dutch Brothers doesn't really fit that mold that I'm looking for. They are going to grow nicely. It is a nice franchise. I like them. I like the experience I had with them, but look at their free cash flow. It's negative. That's not good. When you're going negative cash flow, that means you're burning cash. That means your business is not good enough to generate positive cash flows. And those are my comments on Dutch Brothers. Again, I started by saying that I really enjoyed my experience with them. I like the restaurants that they operate. I thought their coffee is delicious, and that's where I'm at. So good luck with that. Falls Grave. What do you think of Bayer? Bayer had a good week or a good couple weeks because they had some lawsuit that I believe, and let me make sure I got the right one here. So 1 year, what's going on here? Let's see here. 1 month. Yeah. So they had this lawsuit that was pending where I forgot I think it was the weed killer. I forgot the brand, but they own the franchise that people use to kill weeds in their gardens. Well, there was a class action lawsuit that said, hey, people that use that product ended up having cancer. And so they all got together, class action lawsuit. And I think that was resolved in Bayer's favor, meaning they don't have to pay anything out other than attorney fees and all that good stuff. So that was a big relief. And I don't know that I'm looking at the right stock. Do you have a symbol on that? What Bayer are you looking at? I want to say that, there's Bayer. They're in Europe. I understand. I think they're out of Germany. It's Bayer RE. Okay, so I guess I'm looking at the right one. It's a $30 billion company. And I mean, it's a decent healthcare company. I think from what I know, they do a lot of over-the-counter things. They're not quite like deep into the science as like a Eli Lilly or a Pfizer. But that's a stock that's out there. Bristol Myers is also out of Europe, and they do really well. Novartis is out of Europe. They're doing great because they have that weight loss drug. There's a lot of good choices in healthcare, and I think healthcare is going to have a very promising year, is my expectation. So Bayer's not a bad idea. They just had that lawsuit, get resolved. So that's my comment there. I don't have a ton more other than this is just a very commonly known company. They're not growing a whole lot, so that's not very exciting. Let's take a look at their cash flow. So free cash flow is 5.6 billion. In previous years, it was lower than that. So on average, it's probably about $3-4 billion in free cash flow. And the company's being priced at 30. So I think the lack of excitement is being priced into the stock where, what are they going to do that's going to make them really exciting, right? Like I told you about Pfizer, they acquired a company, they're going to have a new franchise of drugs for these cancers. Eli Lilly has their weight loss drug that's just going bonkers and creating so much value for that company. What's Bayer going to do to make them exciting? Maybe that's why the stock's been, trickling down. It's okay to buy companies at a discount, but you got to know, what are you buying? Are you buying into potentially a nice pop in a stock for 6 months, 9 months, have that exit strategy? Are you expecting Bayer's going to be worth twice as much in 5 years? I don't know if that expectation is going to be met. If you can buy a stock and then see it rise, maybe that's a good play. But I'm not seeing anything overly exciting in this space here. I think there's other options that are really, really exciting out there. There's a couple small companies, United Therapeutics. I really like United Therapeutics. They have a couple of drug franchises. This is what I like about this company. Look at this growth, nice growth. And they're a $2.6 billion company already. And these guys have drugs that help certain diseases, rare diseases. They really work, and they continue to expand the drugs that they're going to do. They're also getting into organ transplants of artificial organs that they grow and then transplant into people that need transplants. It's like just blows my mind that the science has gotten to this point. Just blows my mind. And this company is doing really well. It's been a nice investment for me, really exciting future for them. And do I expect this company is going to be worth twice as much in 5 years? Absolutely. Look at their track record. Beautiful chart. And I started buying into these guys here. So I've been on the elevator ride with these guys going up to the 20th floor. Hopefully it'll get up to 100th floor. So in this space of pharmaceutical and biotech, it's a great space to look for companies. And I would encourage you to, find one that's going to be a 3 to 5 bagger for you, man. I really like United Therapeutics for that reason. All right. Got a lot of comments coming in. Everybody, thanks for joining. We've had this up market. We had one down day. We got to figure out how to make some money. All right. Nichix, I like it because they're diversified. Yeah. I think you're referring back to Pepsi. And I can't argue with that. Pepsi is the right investment for some people. I cannot argue with that. Warren Buffett, one of the greatest investors of all time, he's owned Coca-Cola forever. So, yeah. So Dutch Brothers is, I think growth catches a lot of attention when a company's growing, and it should. But what I would encourage you to think about is growth in the restaurant business is a different animal than, hey, you are a potentially, let's say you're a security software company and you do exactly what CrowdStrike does. But CrowdStrike just blew up the planet when they had the biggest outage in computer history. If you found a company like that, that's squarely in the green. Software companies have these huge margins. They write the code once and they sell it to 1 million customers. It's an awesome model. So I would say that growth is great, but growth in the right industries is incredibly powerful from an investor's return perspective. Finding growth in the best industries, that's where the money's at. Finding growth in the wrong industries, it's interesting, but at the end of the day, you own a restaurant. You got to hire more people. You got to lease out expensive real estate. You got more, exposure to lawsuits for somebody burns himself with your coffee, or lawsuits from employees. They unionize. All these undesirables exist with that type of business. So that's how I see it. Hopefully you found that interesting. All right. So Mr. 123 Cheetah, man, I miss talking to you guys, man. And thanks for tuning in. What do you think about oil stocks have been lagging? So oil prices are down, right? So when we look at oil, it's a simple market that has these international ramifications, because as we all know, oil, a lot of the reserves are in the Middle East, and that's where a lot of the oil comes from. The US is actually generating more oil than we use. We actually export it now, which is great. And we're energy independent with that respect. But you can see that oil prices go up. And right here, when you look at oil prices peaking at like $93 a share, let me go to a 5-year. I think that's better. So here in 22, oil companies are priced really high because oil prices were $120 per share. It's really settled down around 74. Oil companies, my rule of thumb, and I've heard other people that track oil companies. FYI, I worked at an oil company. It was my first job out of college. Your first job professionally always sticks with you. Like, oh man, I remember everything I learned, everything they taught me. And I always owned oil stocks ever since then. So that's why I love oil companies. Part of it. They gave me a nice job coming out of college. Thank you. But more recently, as we look at the 1 year, you can see that oil prices are kind of coming down. You had tension, in Israel, and it really drove up some oil prices. If an oil company gets an oil price of $60 or higher, they're profitable, with a decent margin. If it's under $60 a barrel, they're going to be struggling. They got to be very efficient. 74 is not much north of $60 per share. So back to your question of what's going on with oil stocks. Well, the oil price is at 74. So it's not that exciting. If you get oil up to $100 a barrel, oh man, you better believe those oil stocks are going to begin to work. Now, what's fascinating about oil, for some crazy reason, is it seems like every recession that comes around, it has a combination of oil prices increase, and it creates a tension on the economy where people have to pay their money for gasoline, companies have to pay fuel cost, airlines have to pay more for fuel cost, and that creates a worse economy. And for some reason, oil always shows up at the beginning of a recession. Oil prices shoot up. And that's been kind of interesting. We'll see. We'll see if we start slowing down as an economy and oil prices shoot up. That may make the recession a little worse because people have to spend more money on gas. They don't have money left over to buy discretionary items. So those are my thoughts on oil companies. Monsanto and Roundup. Yeah. That was the lawsuit with Bayer. And it looks like I was looking at the correct symbol. What threw me off is they're out of Germany, and I wanted to make sure I was talking about the right one. So BTBT, Bit Digital, man. On Sunday, we had the community investor conference call, and a guy by the name of Brian, I don't think he's on the live stream, but mad props to Brian because he had a couple of stocks that he suggested, and one of them was BTBT. And I looked at it, and everything I looked at, I was like liking. And I did a full video on it. I put a lot of time and energy into it. I released it today. I encourage you to watch it. The long and the short of it is I'm not the only one that likes the company. They announced their earnings, and the stock price went up 20%. Yes. And I bought shares yesterday. So, man, of course, it leaves me thinking, man, I should have bought like a lot more, but that's being greedy. At least I bought some shares and made some money. All right. So what's going on with this business? What makes them exciting for me, right? If we look at the 5-year, and we're going to look at the 5-year over here, this company started by being a Bitcoin miner. They put their GPUs, those are graphical processing units. Those are accelerated computing units. They're much faster. Like the computer I'm working on, if you had a GPU, it's the equivalent to having 80 computers kind of working on one workload. In the case of Bit Digital, they started by taking these GPUs and mining Bitcoin, and they became good at it. Now, when Bitcoin was above $70 a share, a coin, boy, everybody thought these miners are going to make a ton of money, which they were making lots of money. But then Bitcoin crashed, and the market said, you know what? We think you're terrible. So we're going to sell you off by 97%. 3 cents on the dollar. You can buy that company for 3 cents on the dollar. Now, when I was presenting with this idea, okay, what changed? Because I'm not into Bitcoin miners. I'm concerned that, it's single industry, just one way of generating revenue. Well, this company said, hey, we're really good at managing GPUs, and the GPU technology is what's powering AI. So we have a new business where we offer high performance computing for AI companies and gaming companies. And that's going to be a big growth engine for us. And when he said that, I'm like, okay, the picture has changed. They're very profitable. Check out my video. And they're very profitable on the new business. It's a high growth business. They're growing at 200% in the quarters. You don't see 200% all that often. I mean, 266%, 220%. Okay. Now that caught my attention. So I probably spent collectively about 6 hours of research on this little company, and it's the real deal. And I'm like, holy smokes, man, look at this stock price, $3.61. Could I see this stock double, triple? Absolutely. If these guys keep doing what they're doing, going into the markets and having the margins that they have and the profitability and the cash flow they have, these guys have a very strong proposition. Analysts don't disagree. They're saying it's discounted by 66%. So this company, right, you got a company, back to my little chart where I look for companies that have a lot of what I classify as desirability. So where the heck does this little company, because they're little, they're not big. Well, they're not in the gray completely. I think they're halfway gray, halfway green. halfway great because they do have competitors in the whole Bitcoin mining thing. There's also big hyperscalers that want to compete for the high performance computing. But these guys have things like they run some of their data centers in Iceland where the power is super cheap. It's a very good idea. They go after places where the energy costs are really low, so it keeps their operations really profitable. So over the years, they've developed advantages to operating GPU accelerated computing, and now they're using it in AI, which is a expansive, growth model. So that's what I liked about the company. And I think they're so beaten down. The market said, hey, we're going to sell you and you're going to be worth 3 cents on the dollar. If they just go to 10 cents on the dollar, I just tripled my money. So the proposition's pretty attractive to the upside. And it was a really fun one because, when you find something like that, it's really fun that somebody in the community came in with the idea. We looked at it on the fly, and then I took it and ran with it. I created a video. Please watch it, and you'll see more of my comments on Bit Digital. I didn't make a video yesterday. And the reason for it was they announced their earnings, but they only did it verbally, and they didn't release their financials until today. And then I got a hold of the financials, and I could do a complete video. So I released it somewhere around 10 a.m. Pacific. And there you have it. So thanks for bringing that up. I'm glad you did. Cool. BMY, Bristol Myers. That's a solid stock. It's always been a solid stock. We talked about Bayer. What about KVUE? KVUE. So these guys operates a consumer health company worldwide. Company operates 3 segments: self-care, skincare, and beauty. Essential health, self-care. Okay. So those guys are in that category. They're a pretty good sized market cap, 41 billion. Okay. We're not talking small potato. 5 years, 2%. Now, this is a competitive market, right? When we talk about skincare, you go to the pharmacy or wherever you buy your skincare products, maybe Target. There's like 50 brands. It's like, holy smokes. It seems that the advertising has to be pretty high just to gain market share. For me, skincare, just get me some stuff. I don't really care on brand. Toothpaste, my lovely wife takes care of me. She buys the toothpaste and makes the decision on skincare. But maybe for ladies, it's different. So in this case here, this company, again, it's not a super desirable industry for me, but recently, holy smokes, look at that. Boom, they popped. What's going on? Is it revenue growth? Let's take a look. So their revenue isn't setting any records. So what is popping about it? Is it an acquisition that they're going to be acquired? Free cash flow is looking at the quarterly. So let's go to annual. So free cash flow is 1.7 billion, 2.7 the year before. I mean, very good cash flow, very good cash flow. Now, they're not growing, so I wouldn't be able to value the company near 40 billion. I'd probably value it around 20 billion, judging from their cash flow level, because they're not growing a whole lot. I mean, you got single percentage points in the low single, right? 1%, 4%, less than 1%, 3%, less than 1%. So this one doesn't get me overly excited. It's in a competitive industry. It's not like they have a pharmaceutical that resolves some really bad illness that a lot of people have, and they bring that treatment to people, and they get a very good price for it. They do have a very nice dividend. Analysts think it's fairly priced. I would have a hard time valuing this company near their valuation. So those are my comments on Kenvue. David, thanks for joining. Is ADI the type you like? ADI, well, I'm not sure. So Analog Devices. Analog Devices designs, manufactures, test markets, integrated circuits. Maybe. Integrated circuits are being really pumped. Wow, that's a nice chart. That's it. When it's up and to the right, that's an initial sign of quality. That means they're doing something right and they keep doing it. They're a $110 billion company. All right. So Analog Devices is not like NVIDIA that's pretty much printing money right now. They manufacture GPUs. They're the best accelerated computing, high performance computing GPUs in the world. They're not that company. These guys do other types of pieces, circuits for computing. Not as valuable. Now, when we look at their income, they had a very high growth year in 2022. But this is, so semiconductors are cyclical. Bad year, good year, somewhat good year, bad year. Okay, so you have cyclicality, you have ups and downs. That's normal. That's normal for this semiconductor industry. Now, when we look a little closer, wow, there's a lot of red, man. Red makes me nervous. What's going on? What is going on with ADI? So let's take a look at their chart here. So they had this big drop along with everybody else, right? About a month ago, we had a pretty good correction, went down 17%. Now they've been rising with all these semiconductor companies. I believe the semiconductors are way overpriced right now. I've been an owner of Broadcom. I owned NVIDIA years ago. I've owned TSM, tripled my money on TSM. I've been an investor in semiconductor. I've seen this cyclicality, these cycles of revenue growth followed by lackluster growth. And my prediction is that semiconductors are going to have a reckoning. I think stock prices are really going to drop. Analog Devices, I think, is benefiting from the whole space just being priced really high. And I started with that story of how one of the big AI companies has to deal with a class action lawsuit because they're being accused of stealing a lot of the intellectual property from these books without permission. And that's the kind of thing that's going to slow AI down. And if they slow AI down, they're going to slow the data center buildouts. When those data center buildouts slow down, Analog Devices are going to slow down. NVIDIA is going to slow down. Broadcom's going to slow down. It's just logical. It's going to happen. AI is going to evolve, but it's not going to be a 10-month evolution. It's going to be like a 10-year evolution. It's like the internet. It didn't happen overnight. It happened over years, maybe a decade or two. So overall, Analog Devices has had a very good rise, but I'd be careful right now with semiconductors. I think there's a lot of downside that can happen. Year to date, this is doing 13%, not overly crazy like NVIDIA or Broadcom. Yeah, it looks okay. Let's take a look at their free cash flow. So they're a $110 billion company. Free cash flow. So they're cash flowing $3 billion. No way I can get to 110 billion. So 3 billion. You divide 3 billion by 110, you're dealing with like a 2.5% yield of free cash on that investment. You can buy a T-bill and yield 4%. And that's close to zero risk unless the federal government ceases to exist, which is very unlikely. But this stock, you'd be yielding less than a treasury in free cash. And that's just not a good proposition for me. That's why I'm like really concerned staying away from semiconductor. I'm actually shorting a few semiconductor companies, which include NVIDIA and Broadcom. So those are my comments on ADI. I do like technology. I do think technology like an NVIDIA is a perfect example of a company that's in the green. I just think NVIDIA is way overpriced. If you look at what they're potentially going to do, it's priced for perfection plus the energy and the momentum that's taken the price even higher. If they have any slowdown in the deliveries of GPUs, NVIDIA, you're going to see that stock crash. But they still fit the green. It's a very desirable business, but it still has to be priced right. I don't own Microsoft. I think it's a phenomenal company, fits in the green. The stock's too high. I don't own Apple, phenomenal business in the green, but stock's too high. But I do own Meta and Alphabet and Amazon. So, all right, now we're cooking with gas. Let's keep going here. Patrick, very nice to see you, man. Thanks for joining. Just joined. Is Drone Shield interesting to you? So drones shield. Do you have a symbol on that? So thoughts on. So if you can get me a symbol on what I'm supposed to be looking at here. So drone shield. I think this is it here. CDRO. So correct me if I'm wrong. Let's see comments. I'm probably right here. So DRO. Why am I not seeing it here? But I'm seeing it here. So this is the Australian stock market. I can't get a lot of data on this. Okay, so artificial intelligence, multi-mission threat protection. Looks interesting, most definitely. I think this looks really interesting, but I'd have to see the financials, see if they show the financials. And I'm going to go after if you guys have been watching my channel, you know what I'm going to look at. Look at revenue growth, free cash, balance sheet, make sure there's not too much debt. If they're generating a lot of free cash and they're growing their top line and they have a good balance sheet, I like it. If they don't have that, it looks interesting, but it may not be a good investment. So where are the financials here? So sectors. Bear with me. I'm looking for the financials. So they have videos. Well, they do a nice job of promoting their company. I'll give them that much. It's just they make it hard to get to their financials, which is kind of silly. We got to get to financials. All right. So I'm sorry, but I'm going to quit on this one. I think it's an interesting business. You got to go look at the top line revenue. If it's growing, I like it. If it has a lot of free cash flow and it's growing their free cash flows, I like it. If the balance sheet, if debt is less than 3 times EBITDA, that's a qualifier. So based on that, then you can start valuing the company and seeing what kind of rate of return am I getting on this stock. So it is an interesting business. I would say that much. All right. So Earthbound Misfit, good to see you. So thoughts on TEM. Tempest AI. So these AI companies, wow, phenomenal. Okay, 58, well, not phenomenal, just okay. So these guys, what do they do? Tempest AI operates as a healthcare technology company. It engages in providing next generation sequencing, diagnostics, chain reaction profiling, molecular. Okay, so they're using AI to try to probably do some machine learning and help in the discovery at a molecular level for these scientists. Okay, that kind of makes sense. Now, here's a big problem is they're losing a ton of money. So I understand their proposition. They're growing, but they're small. They're a $595 million revenue company. They are growing. Interesting. Okay. But they're growing and losing a lot of money. Okay. So they're burning free cash. They're burning $324 million every year. 324 million. Okay, that's interesting. They have basically $490 million of cash on the balance sheet. How much debt? They have almost the same amount of debt. Okay. So they have very little net cash because they have this debt that they're going to have to pay. they're burning on the free cash line. It was 324 million. So they're going to have a cash crunch, right? You got this debt that is going to have to be paid. You got 490 million of cash. You're burning 324. I'm concerned about the balance sheet. There's not a lot of cash on the balance sheet and you're burning cash. So I can't give you a value on the company because they're burning $324 million of cash. What's my value? Negative. This is not a business that I like. They're not generating positive free cash flow. They are growing their top line, but businesses like these can run out of time and money. And I don't know if that's going to be the case for them. Look at this. It's a strong buy, but it's being sold at a premium of 23%. If these guys get to market with a product, or maybe they're acquired by another business, that might be a way for investors to make money. But right now, I think this is very risky due to their balance sheet, due to the fact that they're burning so much cash. So that's where I'm at with that one. Good to see you, David. Thank you for joining. Appreciate your question. Yeah, it's an Australian company. Interesting. And I think AI is going to open up the imagination of a lot of companies, but just keep in mind that, there's just a lot of evolution that's going to happen with AI. It's not going to be like, oh, we're immediately going to have businesses starting. I filmed a video recently on, Amazon has drone deliveries and they have them in 2 test markets. They've been working on it for more than 10 years. And it's been a slow road. You can consider that AI, right? These are drones that are delivering to an address and dropping a small package. The package size and weight is limited, but that's really impressive that they're even able to do it in 2 test markets. Well, that's AI. That's reality. It's taken them more than 10 years for one of the most valuable, intelligent companies to get that far, or really for the progress to be that slow. That's what I continue to think about AI is. I think it's going to be really interesting in the future, but it's investors grow impatient. Investors look at annual returns. And if they start sitting on, companies that aren't growing and maybe are burning too much cash, those stocks are really going to suffer. Amazon, the great Amazon, if you look at their history, when we had the .com bubble burst, you saw this stock, and you can't really see it, but you can to some extent. I wish I could kind of grab this right here, but for a while, their stock really went down. See how it went down to like pennies, and they were much higher? The stock really tanked like 80-90% after the .com bubble. Amazon, right? And now they're worth a gigantic amount. But companies really have to go through a lot when they're in a new paradigm, when they're in a new industry. So we'll see what happens. I don't think we're going to see it happen in the next 12 months, by the way. We're going to see it happen over the next 10 to 15 years. That's my opinion on it. All right, everybody. It's been a good session. It's been an up market. So let's hope that it continues to be an up market. I wouldn't mind that. I wouldn't mind that at all. It's been nice. Now, a couple weeks ago, it was really interesting. Stocks were crashing after they announced good earnings. We had a really strong pullback. It was super interesting to do live streams. It was super interesting to analyze stocks. I was glad that I got into more cash a couple months ago because I had that cash ready to invest in companies like Amazon. But now that we've had a nice week of green, I like green. It's like, all right, cool, man. We can kind of take it easy a little bit and see our investments go up and reap the reward of making the right calls months ago, years ago, and seeing the benefit of it. So with that, everybody, have a nice evening. Good luck. Let's hope that the market opens up higher tomorrow, stays up, and we make lots of money. I appreciate all the questions. Have a good night.